Good evening, class. Good evening.
Yeah, good evening.
Yeah, this night, sorry for coming late. I'm just coming from the office. So this night we look at taxation of merger and acquisition. So we start with what is merger, what is merger, what is acquisition. So what type of merger do we have? We look at that. So that is what we want to discuss this night. Taxation of merger and acquisition. So first and foremost, what is merger? Merger simply means a form of business combination. Merger simply means a form of business combination where two or more companies come together, join together to become a one surviving company. Example of merger: A is a company A Limited, B Limited. They want to combine their assets together. They want to join together to become one. So A Limited and B Limited want to combine together to become one. Once they combine, they will now bear a new name called AB Limited, or they will bear a name that will be different entirely from A and B. So merger simply means a form of business combination where two or more companies come together or join together to become one large surviving company. What is acquisition? Acquisition simply means a situation where the assets and liability of one company is acquired by another company. Acquisition simply means a business combination or business reorganization or business arrangement where the asset and liability of one company is acquired by another company. In acquisition, when example of acquisition, A acquire B, A Limited acquire B Limited. That means A is going to lose, A will not lose his brand, B will lose his brand. A acquire B, there is a company called A Limited, there is a company called B Limited. A now acquire B Limited. That means B is going to cease operation, A will still continue. And after A acquire B, his name will not change. It will still be bearing A Limited. That is acquisition. Now, let's look at type of merger we have under taxation. Under tax, there are two types of merger: horizontal merger and vertical merger. Horizontal merger and vertical merger. What is horizontal merger? Horizontal merger means a situation or a form of business combination where two companies in the same line of business join together to become a large company. Two companies in the same line of business join together to become what? A large company. Example of horizontal merger: Chartered Bank and IBTC Bank, they merge together to become Stanbic IBTC Bank. So that one is a merger. That one is horizontal merger. Chartered Bank is a commercial bank. IBTC Bank they are in the same line of business. They now merge together to become a larger company. Because when they merge together, the assets will increase. It will create value for the asset. Now, what is vertical merger? Vertical merger simply means a situation where two companies in the same industry, but different line of business join together to become a large company. A situation where two companies in the same line of business join together to become a large company. In the same industry, but different line of business. That is vertical merger. In the same industry, but different line of business. They now join together to become a new company. That is what is called vertical merger. Now, let's look at benefit of merger and acquisition. Benefit of what are the benefits that we are going to derive when two companies merge together or when one company acquire another company? What are the benefits? Number one benefit is there will be improving management. So merger and acquisition will bring improvement in management operation or management service. That means they are going to have effective management service. So there will be new skills, new brain, new idea is going to come in. Another benefit of merger and acquisition or reason for merger and acquisition is increase in economic of scales. Economic of scales. That means they are going to produce larger quantity when they merge together. When A and B merge together to become AB Limited. So the production that they will be producing will be more than when they are operating separately. Another benefit is profit growth. Profit growth. The profit of the company will improve. That is profit maximization. The profit will improve. The profit of the company will improve when two companies merge together or when one company acquire another company. There will be increase in profitability. Tax shield. When two companies merge together, there will be some tax advantage or tax incentive that they will be entitled to compared to when they are operating on a different entity. So when they merge together, the tax that they will pay will be lower compared to when they are operating on a different entity. That is one of the benefits of another one, increase in market power. This one is talking about increase in market shares. When two companies merge together to become a larger company, the market shares that they will have will be increased. They can compete with other companies effectively because they will have increase in market shares. They can dominate the market rather than operating separately. Increase in another benefit of merger and acquisition is increase in shareholder wealth maximization. The value of the company share will increase when two companies merge together. Shareholder wealth maximization. So those are the benefits of merger and acquisition. Now, where we are going now is, let's now look at tax implication of merger. Tax implication of merger. Let's look at tax implication of merger. If they want to ask you what is the tax implication of merger, they can ask it in different way. They can ask it in another way. They can ask what is the tax implication of a new company taking over an existing company. What is the tax implication of a new company taking over an existing company? You know, when A and B merge together to become AB Limited, A and B, A is an existing company, B is an existing company, but AB Limited is a new company. A and B, they will lose their brand. They now start a new company called AB Limited. So another way they can ask tax implication of merger, they can ask what is the tax implication of a new company taking over two existing companies or taking over an existing company, because A is taking over, AB Limited is taking over A. It will take over the asset of A. It will also take over the asset of B. What is the tax implication of merger? That is where we are going. So, number one, when there is merger, what are the tax implications? Number one tax implication is the old company is deemed to have ceased business. Why cessation rule will apply to the old company? When A and B merge together to become AB Limited, A will cease operation, B will cease operation, and we are going to apply cessation rule to the two companies. The next one, the net tax implication, the new company, that new company that they just formed, AB Limited, is deemed to have commenced business. That new company, we are going to assume that it just commenced a business, and commencement rule will apply to the new company. Commencement rule will apply to the new company. Another tax implication, filing of annual tax return. That new company is expected to file its company income tax return within the first 18 months from the date of commencement, or within 6 months after the end of the accounting year. Another tax implication, claims of capital allowance. There will be no initial allowance or investment allowance on the asset transfer to the new company, but an annual allowance will be claimed based on the tax written down value. What we are saying is, if A and B merge together to become AB Limited, the qualified capital expenditure of A will be transferred to AB Limited. The qualified capital expenditure of B will be transferred to AB Limited. That qualified capital expenditure that was transferred or taken over by AB Limited, we said it just commenced a business. Despite that it just commenced a business, we are not going to claim initial allowance on those qualified capital expenditure, because those qualified capital expenditure, they have been used before. They are old assets. We can't claim initial allowance. We can only claim annual allowance. And when we want to claim annual allowance, we claim annual allowance based on the remaining useful life according to the capital allowance rates. We claim it based on the tax written down value. Now, another one, another tax implication, another tax implication. Unabsorbed losses and capital allowance brought forward. The unabsorbed losses and capital allowance of the old company, that old company, or cease company, that company that will cease operation. In case if A or B have any unabsorbed losses and capital allowance, what is the treatment? Unrelieved or unabsorbed losses and capital allowance of any of the merging company will not be allowed to be carried forward or set off against the profit of the new company after the merger. What they are saying in essence here is A and B want to merge together to become AB Limited. If A has unrelieved loss at the time of merger, or they have unclaimed capital allowance at the time of merger, that unrelieved loss or unclaimed capital allowance, the new company that was just formed cannot take it over. You cannot claim the unrelieved loss or unabsorbed. So we cannot set the unrelieved loss or unabsorbed capital allowance against the profit of the new company after the merger. So that is that. Another one, when there is merger can result into increase in share capital. When there is increase in share capital, that increase in share capital will attract stamp duties. When A and B merge together to become AB Limited, there will be new capital structure from the AB Limited. A will have shares in B Limited. B2 will have shares in AB Limited. That shares that they have in AB Limited, they have to pay stamp duties on it while they want to register it with the Corporate Affairs Commission. Because they will go and register AB Limited in the Corporate Affairs Commission because AB Limited is a new company on its own. It's a new company on its own. At the time of registration, when they are allotting shares to the shareholder, each of the shareholder will pay stamp duties on the allotted shares. That is another tax implication. Another tax implication is the professional fee incurred during the merging process. At the time of merger, we need to engage some professional. We need to engage the professional like accountant that will help us to prepare business combination, that will help us to determine the net assets. We also need a professional like estate valuer that will value the assets, especially the land and building. We also need a professional like legal practitioner that will prepare the legal agreements. All these professionals, during the merging process, we are going to pay them professional fee. That professional fee we pay them will be treated as a disallowable expenses. We cannot claim that professional fee. That professional fee is somehow regarded as preliminary expenses. The new company that was just formed, if it was stated in the expenses of the new company that professional fee pay for margin of the two companies, if it was stated in the account of the new company, it will be treated as a disallowable expenses because we regard them as preliminary expenses. Another tax implication is that the professional fee paid to professional in connection with merger will attract value-added tax and withholding tax. It will attract value-added tax and what? And withholding tax. It will attract value-added tax and withholding tax. All relief capital allowance at cessation can be carried backward and set off against assessable profit of 5 years preceding year of cessation. You know, we said A and B want to merge together to become AB Limited. If A have unrelieved losses, the law provided that A can carry the unrelieved losses backward. He cannot carry it forward to the new company. Because, you know, in the last year of A, we are going to apply cessation rule. And any unrelieved losses during cessation period can be carried backward. Only unrelieved capital allowance. Unrelieved capital allowance, sorry, not losses. Unrelieved capital allowance during cessation can be carried backward for maximum of 5 years. But the unrelieved losses at the time of cessation will be regarded as terminal loss. That loss is a final loss. You cannot carry it backward. But in the case of capital allowance, in the year of cessation, when you have unclaimed capital allowance, the law provided that you can carry it backward for maximum of 5 years. So those are the tax implications of merger. Those are the tax implications of merger. Now, let's look at tax implication of acquisition. What other way can we state acquisition? They can ask, what is the tax implication of an existing company taking over another existing company? An existing company absorbs another existing company. You know, in acquisition, A will acquire B. That means A is taking over B. Two of them are existing company, but one of them is taking over another. That is acquisition. So what is the tax implication of acquisition? What is the tax implication of acquisition? Number one, in acquisition, we have absorbing company. We have absorbed company. The absorbing company is the one that acquire the absorbed company. Example, assuming A acquire B. A is the absorbing company, while B is the absorbed company. The absorbed company will be deemed to have ceased operation. The absorbed company will be deemed to have what? To have ceased operation, and cessation rule will apply. Why the company that absorbs will not be deemed to have commenced a new business? A will not be deemed to have commenced a new business. You understand? So as a result of that, commencement rule will not apply to A. But B that they acquire, cessation rule will apply to B. A that acquire another company, we will assume A continue his business. Because when A acquire B, A will not start a new name. A will still maintain his brand. it will still be bearing A limited. So another one, the surviving company, that is the company that acquired another company, will be entitled to investment allowance on an initial allowance on the asset transfer to it. When A acquired B, if any asset was transferred to A by B as a result of acquisition, that asset, if A want to claim capital allowance on the asset, he can claim initial allowance and it will also claim annual allowance based on tax written down. He cannot claim initial allowance. Sorry, it will not claim initial allowance. He can only claim annual allowance. And that annual allowance he can claim, he will claim it based on tax written down value. A can only claim annual allowance based on the remaining tax written down value life. They cannot claim initial allowance. Another tax implication of acquisition, unabsorbed losses and capital allowance of the absorbed company, of the company that they acquire, will not be carried forward and set off against the profit of that surviving company or that company that absorbed the other company, that absorbing company. Another tax implication is fee paid to the professional in connection with the acquisition will be subject to value added tax and withholding tax. When A acquire B, A will have increase in share capital. That increase in share capital will attract payment of stamp duties. Another tax implication of acquisition, when A acquire B, the asset taken over A, if B make gain from the disposal of the asset to A, that gain is going to attract capital gain tax. That gain is going to attract capital gain tax. That is the tax implication of acquisition. Now, let's look at another one. Tax implication of reconstituted company. Tax implication of reconstituted companies. What is reconstituted companies? Reconstituted companies. Reconstituted company, they are those companies that they are previously owned by foreign company, but maybe as a result of some government policy, government now said any company owned by foreign investors, we don't want them again in Nigeria. So every foreign investor that has shares in a company in Nigeria, please sell off your shares to indigenous investor, to local investor. The local investors will take over the company owned by the foreign investors. So that is a reconstituted company. In a nutshell, reconstituted company means a company that there is changes in ownership structure. Ownership structure. The company still continue business, but they just have changes in ownership structure. Especially when a company is owned by foreign company, foreign investor, they now dispose it to a local investor. What is the tax implication of the constituted company? Number one tax implication is commencement rule or cessation rule shall not be applied to reconstituted company. Commencement rule or cessation rule shall not be applied to the reconstituted company. Commencement rule or cessation rule shall not be applied to the reconstituted company. Another tax implication. The assets vested in the reconstituted company shall be deemed to have been sold on the date of incorporation of that company. And for an amount equals to the residue of qualified capital expenditure thereon on the day following the cessation of the foreign company trade. What this one is saying now is the qualified capital expenditure of the reconstituted company. We are going to assume at the date of that after the company has been reconstituted, the qualified capital expenditure is going to be stated at residual value. So that is that. C, tax implication. The reconstituted company shall not be entitled to any initial allowance on the asset taken over. And they can only claim annual allowance based on the residual value. What this one means is that the reconstituted company shall not be entitled to any initial allowance on those assets and shall be deemed to have received all the capital allowance granted to the foreign company on those assets. What means is that after the company has been reconstituted, those assets taken over, you can't claim capital allowance on them. You cannot claim initial allowance on them. You cannot claim annual allowance on them because you will take them over at residual value, and the residual value is, I think, 20 naira or 10 naira. You assume that before the reconstitution, before the reconstituted period, you understand that those assets have enjoyed all the annual allowance accrued to them. Another tax implication, unrelieved losses of foreign company on the date of reconstitution shall be deemed to have been incurred by reconstituted company. That means if they have unrelieved losses before the date of reconstitution, those unrelieved losses can be taken over after the company has been reconstituted, after the company is now being owned by local investors. and those losses can be available for set off against any future profit. But before you can claim those losses, you have to seek approval from the FRS. You have to notify the FRS about those losses. And that notification of certified losses must be made within 3 years after the date of reconstitution. So that is the tax implication of reconstituted company. Now, let's look at another one called tax implication of conversion of partnership to limited liability company. Tax implication of conversion of partnership to limited liability company. Partnership can be called A, B, C, and Co. In partnership, we have partner, the investor, they are partners. We have, so example, assuming there is a partnership business called A, B, C, and Co. We may have partner A, partner B, partner C. Because they are getting old and they are looking for the going concern of the company, of the business, of the partnership business is being threatened because of their old age. They must decide that, don't let us do partnership again. Let us convert it to limited liability company so that we can give out the share out so that more shareholder can come in. So let's look at tax implication of that conversion of partnership to limited liability company. What are the tax implications? Number one, commencement cessation rule will apply to the partnership business. That partnership business cessation rule will apply to them. And profits arising from the cessation is going to be subjected to what type of tax? Personal income tax. Because partnership pay personal income tax. Each of the partner, they pay personal income tax on their share of profit or any income accrued to them from the partnership business. Commencement rule is going to apply to the new limited company, and profit arising from such commencement, profit arising from the commencement is going to be subject to company income tax and education tax. Commencement rule is going to apply to the company. Profit from the commencement is going to be subject to company income tax and education tax. Number three, tax implication. Incorporation expenses incurred during the conversion of partnership business to limited liability company will be treated as a disallowable expenses. It's not going to be allowed for tax purpose. And another tax implication is the new limited company is going to be required to register with FRS for the purpose of VAT and CIT within 6 months from the date of commencement of business. The new limited company will be required to register with FRS for the purpose of VAT and CIT within 6 months from the date of commencement of business. Professional fee pay in respect of conversion of partnership business to limited liability company. We attract withholding tax of 5% and value added tax of 7.5%. The capital of the partner, under the partnership, each of the partner will have capital. The capital of the partner will be converted to ordinary shares capital, and stamp duty will be paid to the shares, on the shares. Stamp duty is going to be paid on the shares. So those are the tax implications of conversion of partnership business to limited liability company. So that is what we have under taxation of merger and acquisition. We will have solved question. There's one question that we think we can solve on this merger and acquisition, but the question is not in this material. So that is that on merger and acquisition. Now, our second lecture this night, we are going to look at transfer pricing.
Excuse me, please.
Pricing.
The question you had wanted to solve with us. So
yes,
you want to post it on our platform, since maybe you have the question and the solution, or you want to look at it with us later?
I will do that later. I will do that later. Let's look at transfer pricing. One of the international tax area is called transfer pricing. The topic will be transfer pricing regulation in Nigeria. Transfer pricing regulation in Nigeria. Before we go to this issue of regulation, let's even talk about transfer pricing on itself. The regulation of transfer pricing started in 2012. It commenced in 2012. FRS start regulating transfer pricing, commenced effective from 2nd of August 2012, when the Transfer Pricing Act was signed into law. Objective of transfer pricing regulation is to guide against tax avoidance or tax evasion. What do we call transfer pricing? What is transfer pricing? Transfer pricing, like as we all know, is the price that goods and services is transferred between interrelated companies. A and B, they are interrelated. They belong to the same group of companies. If A renders service to B, what price is he going to charge B? That price A charge B is called transfer pricing. If A sell good to B, that price charged on the sale of the good is called transfer pricing. Do you understand? Why do we need to regulate transfer pricing? Most of the companies, especially multinational companies, they have been using transfer pricing as a base erosion profit shifting. They have been using it to shift profit from one country to another in order to reduce their tax liability. So OECD, Organization for Economic Cooperation Development, now make some action plan on how to tackle any form of avoidance, tax avoidances or tax evasion arising from transfer pricing. They now recommend that every company, every country need to be regulating transfer pricing. Regulation of transfer pricing simply means we need to determine, it is FRS that will determine the arm's length price that any two related company will transfer goods and services among them. When A and B are related companies, if they want to transfer goods, if A want to sell good to B, because they want to reduce tax, A may increase the price. When A increase the price, in the expenses of B, it is a cost. And in the financial statement of B, under the profit and loss account, it is a cost. And that cost will reduce the tax of B. As a result of that, FRS now said, we need to regulate the price. You cannot sell a good that worth, when A want to sell good to B, assuming that good worth 100,000. In order to practice tax evasion or tax avoidance, A may sell the good worth 500,000. FRS will now determine how much is the fair price in the market, how much they are selling this kind of good. If any other company want to sell it to B, how much will that company sell? That is the price FRS will accept that A transfer good to B. That is what transfer pricing entails. Now, let's look at scope of transfer pricing regulation. Okay, please, sorry for interruption. So, under the scope of transfer pricing regulation, we have list of tangible assets. Two related companies. One company can lease assets to another company. A and B, they are related companies. They are under the same group of companies. A may decide not to own any assets. They will be leasing assets from B, and every year they will be paying fee for that lease. So it is a form of transfer pricing. Provision of services. One company may provide service to another company. Lending or borrowing of money. One company may borrow another company within the same group company money, and it will charge interest on that loan. That interest charge is a transfer pricing. Manufacturing arrangement. Two companies within the same group of companies. One company may be the one manufacturing the good, while the second company may be the one in charge of distribution of the good. That means if the first company manufacture, it will sell it to the second company. And they are within the same group of company. That is a transfer pricing. So those are the scope of transfer pricing arrangements. Now, let's look. Transfer pricing in Nigeria started in 2012. It started in 2012. It started regulating transfer pricing in 2012. Administration of transfer pricing regulation. Who administer transfer pricing regulation? Administration of transfer pricing regulation. Under the administration of transfer pricing regulation, we need to first of all know annual transfer pricing return. Every year, any company that is a multinational company, that means the company maybe they have subsidiary in Nigeria, their parent company is in another country, or a company in Nigeria that have some group of companies under them. Every year, they need to be filing what is called transfer pricing return. And that transfer pricing return must be filed not later than 6 months after the end of the year. Not later than 6 months after the end of the year. Objective of transfer pricing regulation. Let's look at objective of transfer pricing regulation. Why do we need to regulate transfer pricing in Nigeria? Number one objective is to provide Nigeria Tax Authority the tools to fight tax evasion. The tool to fight tax evasion through over or underpricing of controlled transaction. Number one objective of tax transfer pricing regulation is to provide Nigeria Tax Authority the tools to fight tax evasion through over or underpricing of controlled transaction between associated company. Associated company are related company that belong to the same parent. Maybe it is owned by the same parents. Two of the company, they are subsidiary to one larger company, which is the parent company. Another objective is to ensure that Nigeria is able to tax on appropriate taxable basis corresponding to the economic activities deployed by taxable person in Nigeria. To ensure that Nigeria is able to tax on appropriate taxable basis corresponding to the economic activities deployed by taxable persons in Nigeria. What we are saying here is to ensure that every transaction that happens in Nigeria, we tax them appropriately. Those transactions should not be moved out of Nigeria through the back door or through transfer pricing arrangement without appropriate taxes. Another one, to reduce the risk of double taxation. To reduce the risk of double taxation is another objective of transfer pricing regulation. Another objective of transfer pricing regulation is to provide a level playing field between multinational enterprise and independent enterprise doing business in Nigeria. That means to ensure that there is no biased treatment to any of the multinational company. All the multinational companies, we are treating them equally. Another one, to provide taxable person with certainty of transfer pricing treatment in Nigeria. To provide taxable persons with certainty of transfer pricing treatment in Nigeria. Now, the next heading we need to go to is transfer pricing policy. Transfer pricing policy. What do you understand by transfer pricing policy? Transfer pricing policy is a document that is required to be filled with the transfer pricing unit of the FRS. In transfer pricing policy, it is a document that contains the rules and regulations guiding the conduct of related party transaction within the group of companies. Transfer pricing policy is a document that is issued by FRS that contain the guideline or rules and regulation guiding the related party transaction within a group of companies. Type of transfer pricing policy. We have group transfer pricing policy. We have local transfer pricing policy. Group transfer pricing policy, it is a transfer pricing policy that is available to a company, a group of companies that their parent or head office are located outside Nigeria. But local transfer pricing policy, it is available to a group of companies where their parent company is within the Nigeria, like Dangote group of company. It's a parent company. They now have Dangote Sugar, Dangote Cement, Dangote Refinery, Dangote Fertilizer. That one, it is local transfer pricing policy that will be applicable to them. But in the case of Chevron, we have Chevron International, we have Chevron Nigeria. In that one, it is group transfer pricing that will be applicable to them. Features of transfer pricing. What are the features of transfer pricing that we have? Features of transfer pricing. Number one, features of transfer pricing. Typically, prospective in nature. Transfer pricing policy, they are typically prospective in nature. They are a prospect. Prospect means guideline in nature. Another feature is they are typically not updated unless there are significant changes in business. Transfer pricing policy, we don't normally update it unless there is a significant changes in business. Another feature, they provide guidelines on the pricing of transaction and methodology. They provide guidelines on the pricing of transaction and methodology. Another feature, they provide feature view of likely intercompany transaction. They provide feature view of likely intercompany transaction. These are the features of transfer pricing policy. Now, let's look at transfer pricing disclosure and declaration form. Apart from filing transfer price, if you want to file transfer pricing annual return with FRS, you have to fill a form called transfer pricing disclosure and declaration form. What are the content of transfer pricing disclosure and declaration form? Number one content, particulars of the reporting company or entity. Particulars of reporting company or entity. Number two, particulars of immediate parent companies. Particulars of immediate parent company. Number three, particulars of directors of reporting companies. Number four content of transfer pricing disclosure form. Particulars of 5 major shareholders of reporting company. Another features, another content, ownership structure of reporting company and related companies. Particulars of external auditor of reporting companies. Particulars of tax consultants of the reporting companies or reporting entities. Particulars of company secretaries of the reporting entities. And particulars of the persons making the declaration. One person will have to be responsible for that transfer pricing declaration or disclosure form. The reason for that is in case there is when you disclose information that is not correct, that person that signed from the company that is responsible will be the one that they will hold, apart from sanctioning the company, apart from the company paying penalties and interest. The director or the MD or the CFO that signed the transfer pricing disclosure, if he puts incorrect information, he may be jailed. They may sentence him to an imprisonment. So anytime you want to disclose transfer pricing disclosure form or declaration form, all the information must be correct. So somebody has to be responsible that he has certified that all this information provided by this company is true information about the company. Apart from transfer pricing disclosure form, if you want to file annual transfer pricing return, what are the content of annual transfer pricing return? Annual transfer pricing return. What are the content? Number one content of annual transfer pricing return is transfer pricing documentation. Transfer pricing documentation. Number two, transfer pricing policy. Number three, completed and signed transfer pricing disclosure and declaration form. Audited financial statement of the company is part of filing of annual transfer pricing return. complete company income tax self-assessment. Company income tax self-assessment. Another one, computation, including all relevant schedules. These are the content of transfer pricing return. In transfer pricing, we will have connected taxable persons. In transfer pricing, we normally have what is called connected taxable persons. Connected taxable person, they are entity or company that are related to each other. They are related to each other because they belong to the same group of company, or they are in the same line of business, or they are owned by a related party individual. Example of connected taxable persons. Let's look at example of connected taxable person. Number one example of connected taxable person is any entity dealing with related parties. That means a parent company that deal with subsidiary, that deal with associate, that deal with joint venture. A parent company that deal with subsidiary, that deal with associate, that deal with joint venture. A member of group of local company, a member of a local group of company. Example of this is a member of a local group of company. Dangote is a local group of company. Under the Dangote group of company, we may have Dangote Refinery, Dangote Sugar, Dangote Cement, Dangote Fertilizer. So those companies, they are related. That means if Dangote Refinery want to do business with Dangote Cement, they are related. They belong to a member of a local group of company. A multinational company, too, is a connected person. Multinational company means a company that is owned by foreign investors that have subsidiary in Nigeria. An entity with pioneer status, too, is a connected person. When you are given pioneer status, like we said previously, under the topic of pioneer incentive, when you are given pioneer status, you are not expected to pay tax within 3 years. Within that 3 years, because you don't want to pay tax, you now be engaging on ethical transfer pricing dealing. So all these are the examples of connected persons transaction. Now, see on this transfer pricing, let's look at the factor that determine that what factor can we consider to determine whether a transfer pricing is done at arm's length? Because why we regulate transfer pricing is to ensure that that transfer pricing is carried out as arm's length. It's not overpriced or underpriced. So what are those factors that we consider for us to say transaction is done? Number one, similarity or identical nature of transaction that is entered into by an unconnected taxable persons. Similarity or identical nature of the transaction to that enter into by an unconnected taxable person. What we are saying is A and B are connected. If A sell good to B, it is part of transfer pricing. So for us to determine the price, we now go outside that if a company that is not connected to B sell good to B, that particular same good, how much will that company charge? The amount charged by that company will be the transfer pricing. Regulated amounts. That is the arm's length price. Another factor The fact and circumstances of the transaction. The fact and circumstances of the transaction is another factor. The characteristics of the goods and services transfer. The characteristics of the goods and services transfer. The function undertaken by the persons entry into the transaction. The function undertaken by the persons entering into the transactions is also another factor that we consider to determine whether a transaction is done at arm's length under transfer pricing. The contractual terms of the transaction. The contractual terms of the transaction. The contractual terms of the transaction is also another factor to be considered. The economic circumstances in which the transaction is taking place is also another factor to be considered. The business strategy pursued by the connected persons to the control transaction is also another factor to be considered. Now, for the sake of time, let's look at method of transfer pricing. What method do we use to transfer price? Number one method of transfer pricing, comparable uncontrolled price method. Comparable uncontrolled price method. In this comparable uncontrolled price method, we determine what price will external party that is not within the group of companies charge if you want to sell good among themselves. A and B, they are related parties. A sell good to B at the rate of 18 naira. For us to determine the transfer pricing price, we now go and look. C is not related to D. They are not connected. If C want to sell the same good that A sell to B, how much will C charge D? Because C and D are not related, but A and B are related. The price C charge D is what we are going to consider as the price of transfer pricing. That is comparable on in resale price method. If A want to transfer good to B, how much is the selling price A is selling that good? The selling price A is selling that good to other customer outside is what we are going to use to transfer the good to B, because A and B are related. But how much if A want to sell the good to external party? The amount will be the transfer pricing price. Cost plus method. In cost plus method, if A want to transfer good to B, for A to determine the transfer price, A will consider the cost of the good and add his own profit margin. And that his own profit margin will be depends on the cost he added. It can be 20% of the cost, 10% of the cost. It depends on who is responsible. Profit split method too is another method. In profit split method, the profit arising from that transfer pricing transaction is going to be splitted between the two companies, the company selling the good and the company buying the good. That means in profit split method, if A want to transfer good to B, it is half of the profit that A is supposed to make that is going to be added to the cost of the good. So that is another method. Now, what is the fines and penalties relating to transfer pricing regulation in Nigeria? What are the fines and penalties relating to transfer pricing regulation in Nigeria? Another number one fines and penalties Failure to disclose control transaction. Failure to disclose control transaction. One of the if you fail to disclose control transaction, the company that failed to disclose control transaction, they will pay a penalty of 10 million naira or 1% of the value of the control transaction. Which one is higher? Apart from paying penalties of 10 million naira, they will now be paying 10,000 every day in which the failure continues. They will be paying 10,000 every day in which the failure continues. So that is on failure to disclose control transaction. Another penalties, another offenses relating to transfer pricing, late filing of country by country return. When you fail to file country by country return, late filing of country by country return, 12 months after the end of the year, a company need to file country by country return of the last year transaction. If you fail to file it, that company will be entitled to pay a penalty of 10 million naira in the first instance and 1 million naira for every month in which the failure continues. 1 million in every month in which the failure continues. So those are the offenses of transfer pricing. So in this transfer pricing topic, you can read more on this transfer pricing topic, and I gave some examinable question. That examinable question in this transfer pricing topic, please, let's try to look at that examinable question. Please, that examinable question, especially examinable question 2, can be tested in our exam direct from source. Examinable question 2 can be tested in our exam direct. Examinable question 3 too can be tested. So please, let's try to study the examinable question on this transfer pricing. Do we have any question on this transfer pricing? You can read more. It's just a little late. So do we have any question? In the absence of no question, so please, let's try to call it a day because we are going to work early in the morning. So if need be, by God's grace, on Saturday, we will end our lecture on Saturday. So if I have like 1 hour or 2 hours, we do general revision and we look at the last topic we may look at is current issue in international taxation. Current issue in international taxation. We look at that first and we now do general revision. So any question, any query, any question, any query? So in the absence of no question, I think we can call it a day. Thank you for having me. Have a good night rest.
Thank you, sir. Good night.
Yeah.
Thank you, sir.